The over 200-year-old multinational chemicals company Johnson Matthey is currently trading 60% below their all-time highs and roughly at the same level as they did back in 2006. Their juicy 5.4% dividend yield makes them very appealing for investors looking for a passive income. But the company has had a hard time in the last years and overall wasn't such a good investment. Now, their biggest institutional investors has taken a more active approach and has written an open letter to the company and their shareholders with some proposals on how to turn the boat around. So in this video, I will analyze what JM exactly does, how their financials look like and why they are down so much. I will also see if they are a good long-term investment with these new catalysts on the horizon. I am Florian, this is Cashflow Maniac. Thank you for joining me today. And by the way, today's analysis was actually requested from AJB17. So first of all, thank you very much for your comment and your suggestion. And if you have any companies that you would like me to take a look at, feel free to leave me a comment down below. I can't promise to cover all requests, but what I can promise is that I'll read every single one of your comments and at least have a brief look at the company. Over the last 12 months, Johnson Matthey had quite a bad performance with minus 15% total performance compared to the plus 17 of the S&P 500. And it did not look much better over the last 10 years. In this time frame, the stock did also decline by 60% overall, but it did also reach their all-time highs in 2018. But since these highs, the stock only knew one direction, and that is down. Also, compared to the FTSE 250 index where they are included, they did also underperform quite a bit over the last 5 years. So all in all, they had a tough time in the recent years. The question is now, will this poor performance continue or is this weakness a good opportunity to buy? And to determine this, we first need to understand what the company exactly does and why the performance was so bad recently. Johnson Matthey was founded in 1817 already and is a London-based global leader in sustainable technologies. The company specializes in catalysis, precious metals, fine chemicals and process technology, where they focus on enabling the automotive, chemical and energy industry to decarbonize and reduce harmful emissions. And they have quite a history of innovation in this sector. For example, they did supply the platinum for the first fuel cells, and to this day they are still trying to leverage their expertise to develop and provide different solutions for the hydrogen value chain, like different membranes and membrane assemblies. In 2022, they announced plans to build a gigafactory to supply components for fuel cells, aiming for a capacity of 3 gigawatts annually. But this is where the trouble already starts. Because when they announced these plans 3 years ago, they did expect to generate more than £200 million in sales in their fiscal year 24-25 with this hydrogen business alone. But when we have a look at the last half-yearly report from November 2024, we find that they are very far from this goal. In the first half of this fiscal year, they only generated £20 million in sales, which is a tenth of what they wanted to achieve for the whole year originally. And not only that, but the sales also declined by 46% since last year, and the operating profit here is even negative. So this doesn't bode too well for the hydrogen business. But it is not only the hydrogen business that is under pressure. We can actually see a similar negative trend when we look at their two biggest segments, the clean air and the PGM service segment, that also both saw a decline in sales that resulted in a decline of operating profits. And by the way, PGM stands for platinum group metals and includes ruthenium, rhodium, palladium, iridium and platinum. They all have similar physical and chemical properties and tend to occur together in the same mineral deposits. And as I just mentioned, these two segments, especially the clean air segment, are responsible for the majority of their sales. Last year, the clean air segment was responsible for 70% of the sales, the PGM for 12%, and the catalyst technologies for 16%, while hydrogen only made 2% of the sales. That's a far shot from the original plans. And in the yearly report from last year, they already noticed this and have already announced that they will dial back their investments and efforts. But it is a bit late now, as their new Royston plant that was built for exactly these products is finished already, and all they can do now is to reduce the operational spending by delaying the start of production and putting a higher focus on government incentives and strategic partnerships. For example, they just announced a couple of weeks ago that they will form a strategic collaboration with Bosch, and their membranes will be integrated in Bosch's fuel cell power modules for commercial long-distance vehicles. And they are targeting to form at least 4 of such partnerships until the end of their next fiscal year, 2025-2026. So this is quite a far cry from their original plans to already generate 200 million in sales with hydrogen alone. And it is also not the first time in the recent years that a strategic plan of the company doesn't work out as planned. In 2022, they already sold their battery materials unit for £50 million after spending 340 million to get it started and another 360 million in impairment and restructuring costs after the sale. So to me, it seems like their management made some very questionable decisions in the last years. And the largest institutional investors in the company, Standard Investment, also thinks that, as they explain in an open letter to the management of JM. Let's have a look. Here they explain that they see 4 major concerns with the company that, according to the letter, have already been addressed a couple of times to the management in the last 2 years without any reaction from them before taking the last resort of writing this open letter. And these concerns are: first, a significant amount of money has been spent on unproven growth business with no path to profitability. This refers to the hydrogen and the former battery business that up to now has only destroyed shareholder value with no end in sight. The second point is that even though their clean air segment is their biggest segment and they are the technology leader here, their margins here have declined while the margins of their competitors have increased at the same time. Standard Investments claims that the management of Johnson Matthey has far too little focus on this business and no clear and effective plan for the future. Thirdly, they see a similar trend in their PGM service segment that is very opaque and is for some reason consuming cash while underperforming expectations without any explanation or guidance from the management. And last but not least, they claim the volatile and meager free cash flow from the company. But they are not only complaining, they also have 3 very concrete recommendations how the company can turn this around. First, they emphasize the lack of qualification of the current leadership and push to refresh the board of directors with one that is ready to take action and bring back the core business on track. Second, they want to see a de-risking strategy with the hydrogen business or potentially even sell it to minimize burning money with this. And it seems like at least this is already taking place in parts with the new focus on strategic partnerships. And lastly, they strongly urge the board to hire external advisors and launch a formal strategic review process to maximize shareholder value, including, and this is important, a sale of a part or even the whole company. So this sounds all very drastic. But because the letter was only sent very recently, we need to see how the company reacts to this over the course of the next months. In their last annual report, they still outline the following growth paths. Over the medium term, they want to bring back their growth to high single digits. With this, they think that by 2030, the current growth business alone will be bigger than the whole company today. Honestly, after seeing the handling of the battery business and also recently the hydrogen business, I am not sure how they want to achieve this, but it is still their plan. And in the midterm, they see especially the catalyst technology sector as the major growth driver, while the hydrogen business should also contribute here in the long run. So let's take a deeper look into this catalyst sector. At the moment, they make 90% of their revenue in this sector by selling catalysts itself, while 10% are coming from the licensing business. As the major growth driver, they see a significant shift to more licensing, as well as their leading position in production of syngas. Here, they are the market leader especially in methanol, hydrogen and formaldehyde processors, and only one of 2 global players that can provide a very integrated portfolio that can cover the process side as well as the catalyst side. By 2030, they think that 40% of this business will be licensing business, while the growth and margin should further increase. Now, here's the issue I have with all these slides. They show the expected growth and market share. They show in which segments they want to grow, but what they don't show is any concrete strategy and how exactly they planned to do this. And the last plans they communicated did not turn out so well. So from what I can see here, I am not very convinced that they can pull it off this time. We'll look at their concrete financials in a second, but before that, let's also have a brief look at the remaining segments. Their currently biggest segment, where they make 70% of their revenue, the Clean Air segment, should also contribute to the growth, at least in the short term. Here, JM is one of only 3 global players that provide systems to remove pollutants from diesel and gasoline cars. For light-duty diesels, which is mostly passenger cars and small trucks, they are the market leader in Europe, while for heavy-duty diesels, which are large trucks, they are even the global leader. But here we also see one of the issues with this business. Even though this is currently by far the biggest segment, the trend to EVs will not help them to grow here much longer. What I find probably most interesting is their last segment, the PGM services. Here they are the world's largest secondary refiner for these metals, which means that they use recycled materials. And they can cover the whole value chain, not only for recycled materials, but also for newly mined materials, and starting from refining up to the production of the final products. And while products for the clean air segment, like auto catalysts that they count to low value PGM products, make up around 1/3 of this business today, they expect that part of the high value PGM products, like high-tech products, will increase over the next few years. This should make this business more independent from the PGM material price, as well as increase their revenue and margins here. The hydrogen segment, which could arguably be the biggest contributor for long-term growth, and might be the segment why some of you are invested in the first place, is still by far the smallest one. They do have some sales here, but the operating profit is still negative. So, at the moment, this is still costing the company money. They offer a range of products and technologies that support various hydrogen production methods, but also hydrogen applications. These are, for example, catalysts for the refinement of hydrogen or membranes for fuel cells. But with the pressure from standard investment and the strategy shift to cost cuts, the future of this segment is far from secure. Overall, I think that they do have quite a strong position in most of their segments. Their long expertise and technological know-how gives them quite a bit of a moat. But I also think that most of their traditional segments are currently being disrupted, or at least have a very high risk of being disrupted, while the growth path forwards is not very clear for me. But maybe that is also just me being stupid, which I wouldn't rule out. The financials of the company at least show why the stock didn't do much in the last 15 years. The revenue growth has been choppy at best, and the same is true for net income and earnings per share. The free cash flow is also fluctuating like crazy, and I can't see a concrete growth trend here. Over the last 5 years, this resulted in a revenue growth of -1%, a free cash flow growth of 43%, and an EPS growth of 7.5%. But I would take these numbers with a grain of salt, because as we just saw, the numbers are fluctuating on a year-over-year basis, so this growth has not been steady and is different depending on the starting year you look at. The margins are also fluctuating on a year-over-year basis. But here we can also see a clear downtrend over the years for the EBITDA and net income margin, and also for the return of invested capital. Only the free cash flow yield looks quite nice with 5% that have also been more or less stable. That leaves the current margin at 5.1% free cash flow yield, a very low 4.7% for EBITDA margins, and also quite low 2.8% for return of invested capital. And again, the trend has rather been pointing downwards for the last decade. But at least they could keep their balance sheet quite clean. Their current net debt to EBITDA ratio is at a low 1.4 times. This is even below the target range of 1.5 to 2 times, and they did also buy back shares steadily. This has led to a yearly share dilution in the last quarters of minus 2.8%, which is quite nice. And the company is not only rewarding their shareholders with share buybacks. They are also paying a dividend with currently quite high yield of 5.26%. But when we check the dividend history, we see that back in 2019, the dividend was at 85.5 pence compared to today's 77. So the dividend was decreased just a couple of years ago. And that has brought the dividend growth to minus 1.96%. The current payout ratio sits at 65%, which I find a bit high, but still okay. But with the highly fluctuating cash flow, this could also change in any given year, and I see a good chance here that it also goes above my threshold of 70% when the cash flow drops by just a little bit again. So we can safely say that the last couple of years have been quite hard on the company. They themselves see an improvement for the next few years, but is this also the expectation of analysts? The 10 analysts that give a one-year price target for the company have an average one-year price target that is 20% higher than today's price. The most optimistic of them even see a one-year upside of almost 70%, while the lowest price target is just 3% below the price today. The earnings per share is expected to grow by over 15% until 2027, which is more than double the value they had in the last 5 years. But these analysts also think that the revenue will decline even further a bit, with yearly minus 0.13%. This is not a very high decline and at least better than the average decline of minus 1% from the last 5 years. But still, there is also no growth. So it is no surprise that the stock price and the sentiment for the company is at its lows right now. But this is also where the chances for the company lie. Because when we look at the valuation, it is indeed very cheap and far below the sector medians. We have a PE ratio of 4.8 compared to the sector of 21.5, an EV of EBITDA of 5.5 compared to the sector with 8.1, and a price to cash flow ratio of 7 compared to the sector with 8.7. So the PE ratio is not only a quarter of the sector, while the EV to EBITDA and the price to cash flow is roughly 25 to 30% below the medians. But what I find most interesting is the PEG ratio that puts the current PE into context with the EPS growth. Because here we have a very low value of 0.02. A PEG ratio of under 1 can indicate an undervaluation. But this is of course only when the expected EPS growth also occurs as predicted. And even when we compare the current valuation to their own 10-year history, we also see that all metrics are very close to the lowest level they ever had during this period. It seems to me that there is much negativity already priced in, and the expectation and confidence for the future growth seems to be quite low, as indicated by the very low PEG ratio. Before I sum this up and come to my conclusion, let's also compare them to some of their closest competitors to get a better feeling for the whole industry. And if you find this video interesting and want to support the channel, please hit the like and the subscribe button. I am often analyzing smaller and lesser known companies on this channel that don't get so much coverage in other videos. But unfortunately, the YouTube algorithm doesn't like these lesser known companies too much. So every like and subscribe really helps me out a lot to push this video to a larger audience. Thank you very much. So for today's peer comparison, I choose the H.B. Fuller Company, Ashland, Innospec and the Quaker Chemical Corporation. Over the last 10 years, none of these companies could outperform the market. Innospec could still achieve the best performance with 180% total returns, while Johnson Matthey did have the worst one with minus 60%. And this already includes the dividend payments. From a dividend point of view, Johnson Matthey does have the highest dividend yield by far, but also by far the lowest dividend growth. But the valuation is also the lowest from the whole peer group. Of course, they are also the ones that have been growing the slowest, and even though all except H.B. Fuller had a declining revenue, the decline of JM was the biggest. The same is true when we look at the 3 and 5 year average growth rates, where they together with Ashland are by far the worst. All in all, I think that the company shows every sign of a dividend trap. Even though the yield is quite high, their business has been declining for many years now. and their management thinks that they will come back to growth in the next years, and they even expect that their two growth segments that are still quite small today will be even bigger than their whole business today in just 5 years from now. But they fail to show a clear and, at least for me, understandable path to do this. So I am not very convinced that they can really pull it off. But the mounting pressure from standard investments might be able to convince the management to take more decisive actions, and it probably doesn't take much good news to change the sentiment when so much pessimism is already baked in. Still, before investing, I would wait to see any kind of sign that convinces me that they will change their strategy from here on out. But of course, this is just my opinion. What do you think of the company? Do you like them? And do you have any positive aspects that I might have missed? Please let me know down in the comments below. And guys, if you are looking for a company that is operating in a hugely growing market and that did manage to grow the dividends with a double-digit growth rate recently, I have a video right here where I go over the unknown super compounder with huge tailwinds, Prysmian. And this is no financial advice. So before investing, please do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching, guys, and see you in the next video.